You probably heard it. The housing market's cooling off, or we're heading for another correction. There just seems to be no shortage of doomsday headlines or social media posts trying to stir up fear. But here's what's interesting. While the narrative says the market should be slowing, right now the data says otherwise. We're actually seeing an unexpected boost in activity. Buyers are stepping back in, and it's catching a lot of people by surprise. Let's unpack exactly what's happening, why it's happening, and what it could mean for you, whether you're buying or selling, or just trying to make sense of this unusual market. Every year, a real estate market follows a pretty familiar rhythm, 5 distinct seasons that repeat almost like clockwork. First, we have our spring market, and that's mid-March through the end of May, and this is a big one where the majority of homes hit the market and buyers are most active. Summer market, June through August, still strong, but things begin to taper slightly as families travel and kids are out of school. Then we have the fall market. That runs Labor Day through mid-November, and activity cools typically as routines settle back in. We have the holiday season next, and that's mid-November through mid-January. And that's the quietest period when people focus on family, festivities, instead of moving boxes. Our winter, mid-January through mid-March, is a slow but steady ramp up before we start the cycle all over again and enter into the spring market. Usually, both buyer demand and listing activity decline together as we move through the year. But this year, that pattern broke. Inventory is down, and not just a little, it's tightening nationwide. And yet at the same time, buyer activity is ticking up. That combination is unusual for this point in the cycle, and the driving force behind it isn't what most people think. It's not the sudden wave of new listings, it's interest rates. As of right now, the 30-year fixed mortgage rate is averaging about 6.37%. And if you're comfortable with a hybrid product like a 10-1 adjustable rate, you can actually get into the 5s. Now that's a big deal. Just a year ago, many buyers were looking in the 7s or even the low 8s. That 1 point drop can translate to hundreds of dollars per month in savings. And for a lot of buyers, that's the difference between waiting or making a move. So what caused the decline? Some point to the Fed's recent quarter-point rate cut, and yes, that made headlines, but the truth is, mortgage rates have been gradually easing for nearly 2 years, even while the Fed was holding firm. To understand why, you have to look beyond the Fed and focus on something called the 10-year Treasury bond. Historically, mortgage rates in the 10-year Treasury bond move in the same direction, typically separated by a spread of about 1.75%. For example, if the 10-year yield is paying 3%, you could expect mortgage rates typically to sit around 4.75%. But starting about April of mid-2020, right in the middle of the pandemic, that spread exploded to over 3.5%. And that's one of the main reasons mortgage rates shot up to 8-9%, even when the 10-year yield didn't move nearly as dramatically. Fast forward to today, interest rates have cooled, market volatility is settled, and that spread is shrinking back toward its historical norm. That's why rates are falling despite the Fed's posture, not because of it. So let me give you a simple illustration. Today's 30-year fixed rate mortgage, as I said, sits around 6.38%. And if we still had last year's wider spread, that same loan would cost you about 6.73%. And go back to 2023, when the spread was near its peak, and it would be about 7.12%. So even though the Fed hasn't made any dramatic moves, the market itself is correcting the imbalance, and that's incredibly healthy for housing. This spread is tightening, essentially telling us that the bond market believes inflation is under control and investors are comfortable accepting slightly lower returns, which translates to lower borrowing costs for you, the home buying consumer. For buyers, lower rates mean renewed opportunity, not just to afford more home, but to re-enter the market that many had walked away from when rates were in the 8s. For sellers, it means more qualified buyers and a more competitive environment, especially as inventories remain tight. If rates continue to move toward the 6s or even dip into the 5s, that could easily spark a resurgent housing market in 2026. Now, if the labor market truly collapses, we could see rates drop even further. But that scenario comes with its own challenges. The more likely outcome is that rates will bob around the low 6s, and that stability is what the market really needs. Here's the thing. Every cycle has its commentators predicting doom and gloom, pushing the idea that you have to sell now before it's too late. I'm not here to sell fear. I'm here to share facts so you can make informed, confident decisions based on what's really happening and not what's trending in social media. Because when you understand why the market is moving, you're in control of how you respond. If you found this video helpful, give it a thumbs up, like and subscribe for more local market updates here in Porter Ranch, Chatsworth, and in the greater San Fernando Valley. If you're thinking about selling soon, grab my ebook, The 7 Steps to Maximize Your Home's Value Before Selling. You'll find the link in the comments down below. I'm Frank Spencer, bringing clarity to a market full of noise, and I'll see you around the neighborhood.